All right, everyone, welcome back to another roundup, the first roundup of the new year with my beloved co-host, Mr. Mark Yusko. I give you beloved because I missed you over the break, my friend.
No, I missed you as well. And that's the perfect word for, we're recording this on Three Kings Day, the Feast of the Epiphany, the 12th day of Christmas, technically the 12th day of Christmas. And so much about that. We're going to weave into a bunch of stuff here, but we'll start with the reveal. So I got, I do have the Bitcoin orange pants on, and I have it's the halving 2020, but it's really because of mining. Everything I'm going to talk about today has to do with mining and hard assets and the like, as we kind of talk about what's going to be hot in 2023. But the halving 2020, is important because we're coming up in about 3 months to that period where crypto spring ends, crypto summer begins, and we head toward the next halving in 2024. And I also we did our predictions thing with the guys a couple weeks ago, last episode of 2022 TOO. Good riddance, like in the rearview mirror.
I agree.
And so I'm excited about 2023. So what I want to do is my son was working on a poetry project last night for sixth grade, and it kind of inspired me. And so I think we're gonna do our predictions, our macro predictions for the year in haiku. So I'm gonna challenge you, Michael, to haiku. So I my first one that I sat down last night. All that glitters when central banksters print and print gold and orange coin. So
that's a pretty good haiku. That's good.
One. That's one.
Okay.
And then I came up with one actually this morning in the shower that I haven't written down, but rock, paper, scissors, ? Paper beats rock, period. Investing, ? Rock will beat paper. So again, back to the mining theme, hard assets, buy what is hard, get real, another hashtag of mine. Another one, inflation fading, economies are slowing, liquidity reigns. So the pivot is definitely here. Another one, I tweeted something out from Brian Sullivan, who does the really early show, the 5 a.m. show on CNBC. And he said, even if over the next 30 years, we get to 120 million EVs on the planet from 15 million today, we should have no decrease in the demand for oil because you got to transport all the stuff to make the EVs all around the world. So oil and gas reviled, demand destruction subsides, prices head for skies. So I think there is serious melt-up risk in the oil market. One of my favorites, since I just seated a European long-only manager, heard Europe was dead. No good companies around. Buy what is on sale. So those are a few of mine there's another one. COVID zero gone. China valuations low, stimulus to flow. That's about what the liquidity reigns. And then one more. King dollar dethroned, hegemony up for grabs, yuan, then Bitcoin. So those are my haiku.
Those were, wow, Mark. First of all, you're a Renaissance man, my friend. We've got financial predictions in the form of haiku. That's very impressive. I feel a little underprepared. I'll be honest. We record these guys at 8 a.m. on Fridays. So it was a little while for me to get ready for the 8 a.m. I cannot come up with haikus on the spot at 8 a.m. my brain is not that awake at this point.
Right.
So
and I didn't do it on the spot. He was sitting there struggling to write his, and I sat there and did a few of my own. Oh, the other one I want to talk about, Colleen Sullivan, who is probably listening
she's the best.
On Saturday morning. So in the future, good friend, had this great tweet that I retweeted. By 2025, which is not very far from now, there will be 2 billion Gen A's, Gen Alphas, the largest generation ever. 385,000 Gen Alphas born each day. fully digital native. They'll never use a physical wallet. They'll never set an analog alarm clock. They will never put film in a camera. They will all use crypto. Love that. Love that.
What's Generation Alpha? I've never heard that
it's
term.
After Gen Z, right? So it's the kids being born now. So I guess it's the echo boomers are the Gen X, Gen Y. So my kids. And then I guess the Gen X kids, my daughter's kids are all Gen Alphas. So, it's
interesting.
Kids that are going to be born over the next handful of years, and probably have been born for the last 5 or 6 years.
There's a great anecdote. There was a woman who was very senior at a big bulge bracket bank, and they do a poll for incoming. I forget what is the lowest level. It's below associate at a bank, analyst maybe.
Yeah,
and for incoming interns and
analyst program.
And one of the questions that they'll ask is, who is your banking provider? And they'll have, JP Morgan Chase, Bank of America, et cetera. And the biggest respondent in the last year was other. And it was none of the major banks. And it was, all these kind of alternatives, which is just an interesting statistic,
Well, and it's super interesting. In fact, it was funny. Just the other day, it hit me. I never thought about this when we were rocking and rolling 4 years ago. But when Jason and Pomp and I formed Morgan Creek Digital, I never realized that it was JPM, Jason, Pomp, and Mark. So the new JPM or the anti-JPM, and that is why we're in the then they fight you phase, right? That is why we're going through all this nonsense right now. It is the banks realizing what you just said, Michael, that these Gen Alphas and Gen Zs, they don't need no stinking banks. And that is a problem. And do you know Tur Demeester? Demeester.
Yeah.
Love him. And tried to go into business with him a long time ago, but he moved to Austin instead. But Austin's almost as good as Chapel Hill, but he should have come to Chapel Hill. And Tur, if you're listening, still come to Chapel Hill. But he tweeted out a great chart, unbelievable chart. We talk about S curves all the time. First decade, first 10%, next decade, next 80%, and then the last decade, the last 10%. And that's any trend, right? And he showed cars. And in 1900, the automobile was 14 years old, right? And only about 10% of people had an automobile. And then there was this inflection point over the next decade where 90% of people had automobiles and the horse's carriage went away. And so turns out Bitcoin is 14 years old, about the same as the automobile, and probably going to have the same type of adoption. But I just thought that was, when we talk about technological innovation, disruption, it's on the outs right now, right? I mean, poor Kathy, down every single day, right? People are just selling ARK. I joke the ARK has sprung a leak, and everyone thinks innovation's dead. Look, I'm old. I lived through 2001, 2002. This is exactly like exactly what happened in 2001, 2002. Enron defrauded people. Tyco defrauded people. People were like, oh, this WorldCom, square inch real estate. There'll never be, this internet thing. It's going to die. And pets.com is stupid. And you guys are all idiots. And, board was like ready to fire us at UNC for investing in this stupid stuff. And then, we had this art technology group thing where we put in for every dollar we put in, our cost of the stock was 50 cents, and we sold it for $100. We made 200 times our money, turned $100,000 into $20 million for the university. They're like, oh, I like that. Do that more.
do more of that. Yeah.
Do more of that.
Yeah.
But then it went to zero. Literally, the stock went to zero. The company, but then here's the interesting thing. And this is another chart that I saw this morning that's amazing. If you look at all the comparisons of the bubble that we just lived through to 2000, right, they all look the same, right? NASDAQ went up and then it went down 84%. And, Peloton went up and went down, and Tesla went up and went down. And, everything looks like this bubble chart. But then this guy put the next part of the chart, which is, then NASDAQ went parabolic. Now, it took 20 years, but it went super parabolic, went way higher than the 2000 peak.
Yeah.
Higher.
I use that. I talked to my dad about that for a long time when he was, talking to me about getting in crypto. And he's like, don't you notice parallels to the early .com days? And said, even if, let's take that exact analogy, right? And put yourself in the shoes of someone who's living through the .com bubble. Let's say you lose an enormous amount of the money that you've invested in your assets. If your perspective at that time living through that was, I'm still going to stick in this industry and stay through it, you did phenomenally well. And exactly. there's an irony in people saying innovation is dead. There's no more innovation. These tech stocks are getting. Necessity is the mother of invention. In my experience, it's just at Blockworks, our most innovative things that we've done have not happened during crazy bull market periods. They're during periods where things aren't so good, and you have to get down to brass tacks and say, how are we going to solve problems? And we don't have as much money as we'd like. We need to be innovative around things. That's what interest rates are doing. They're setting a higher hurdle rate for their investments. So
it's getting
eventually
malinvestment.
Great companies will figure out how to achieve returns in excess of the hurdle rate. I want to dig into some of your haikus and your predictions. So you talked about, let's talk about gold and Bitcoin to start things off. So we like the orange coin, we like gold. Give me some more specific predictions here, and maybe we can bring this back, right? Especially gold has a pretty pronounced the net inverse correlation to real rates, right? So I'm assuming if you're predicting gold has a good year, we think real rates are going down this year. What do you think?
100%. Yeah. So look, I think inflation is going to crash, super crash. I think we'll be I'm going to say sub 3 by the end of the year. Okay. We'll be back in that 2 zone. We won't get back to 2, but we'll be sub 3 by the end of the year. Now that reverses. I will say that reverses if my oil haiku is right, which is, I think people totally botched the oil patch. They got afraid, they believed the ESG nonsense, and they cut back on spending. And so there's a real chance, right? I was traveling for the holidays, and there were a lot of people traveling. Went to Park City. There was not a hotel room to be had, right? I stayed in a crappy Airbnb, and it wasn't crappy. It was fine, but I'd take a bus to get to the slope, and it was not fun with a sick kid who got stomach flu, so he didn't get to ski. But I did get to ski, and I had, like I was telling you before we got on air, one of the most glorious ski days ever. 15 inches of new snow with this super skier taking me to places that no human had been. So it was amazing. But a lot of people, I think, misunderstand the supply-demand dynamic. And yes, OPEC has spare capacity, and they could turn the spigots on and hurt the price. But we tried that, right? Biden tried to talk to them and plead with them before the election, and they said, nope, we got a new friend, right? Their new bestie is China, right? They want to join the BRICS. This is a big deal. This is a big, big deal. That if the S is not South Africa is not a developed market. It's not a developing market. It's a developed market. It's a real country, and in a continent that has a lot of developing countries in it. But South Africa never really belonged in the BRICS. But if you add Saudi to BRICS, that's a big deal. And I think Kirill Sokolov, who I love, and actually a bunch of my haiku I stole from some of his thoughts, is I think he calls it the alliance of the aggrieved. So Russia, China, Saudi, India to a lesser extent, and Brazil, basically the Southern Hemisphere, right? Basically the Southern Hemisphere, and Saudi doesn't exactly fit there, but it's kind of on the border. But the Southern Hemisphere he had this great stat. 87% of the world's population had no vote in the rules on which they must comply with, having to do a dollar hegemony, right? Bretton Woods was created by the big uglies after the war, all Northern, all Western, all now aging, slowing, and these burgeoning countries around the world are now aligning. And that creates a really interesting dynamic. And it's why it goes back to why I'm wearing the mining socks today. Stuff, right? Stuff that's produced, whether it's oil, whether it's gold, whether it's minerals. Think about how much lithium has to be mined to get to 120 million EVs. And we've all seen the pictures of the kids, mining cobalt. I'm sure there's a little sensationalism there, but it's real, right? They got little kids walking around picking up chunks of cobalt, putting it in bags in the DRC, because there's only a couple places on the planet where you can get cobalt. So that's a long, winding answer to
gold and Bitcoin.
Like mining materials, gold miners, right? They were just in the toilet. And I think they could have a really, really good year. Now, gold, I think it's going to have a good year, but it won't have a great year because JP Morgan's going to spoof it, right? They're going to try to keep it down, because if it takes off, that damns the Fed, basically indicts the Fed by saying that you destroyed the money, right? Because gold is money, right? And as gold prices rise, we realize that our money is less valuable. Like if other stuff rises, that can be temporal, like I think real estate. I think that's a temporal thing. And with rising rates, housing prices are going to fall. But gold is the ultimate arbiter of value. And that's why I think Bitcoin will have a better year than gold. Like, Schiff's going to be crying again by the end of the year, but he's always crying. He's always crying about something.
Yeah, I would tend to agree with you. I think it's been funny to watch gold over the last year is about flat, and that it's hard to celebrate flat. But then
Michael,
you look
keep
at
talking.
bonds
My
and
cat
stocks
is feeling
have done.
left out, so I have to let him in. But you keep talking.
All right, I wouldn't want the kitty to feel left out.
I
So,
know.
yeah.
I want to take like pictures. Like, tell me you're needy without telling me you're needy. It's like we have 3 square feet in this house, and my dog and cat have to be here. So
yeah, we had a small dog. His name was Bandit. Growing up, and it was always like Bandit. He didn't care what you were doing, but as soon as you went to the bathroom and closed the door, he felt left out and was like scratching it. It's phenomenal. All right, I want to get to this idea of a pivot here, because people, that does seem like to be a very hated prediction, right? It's not going to be that simple. The Fed isn't going to do that. But here's the thing. The Fed began hiking in November of 21, right? So we're over a year into this hiking cycle. And we know that there's a lag when it comes to when there's a change in monetary accommodation. There's a long lag in between when there's a whole series of cascades that tends to happen before the Fed gets what it wants. We know they've been laser focused on employment, right? On a very tight labor market. And honestly, again, today, there was the ADP employment numbers, they came back hotter than expected, so we still haven't necessarily seen what the Fed has wanted to see in order for them to ease the brakes here. And honestly, it's been a bad year for stocks. Not that bad of a year historically, right? And especially when you compare it to the run up. So I'd be curious, like, when do you think, because I think before the Fed, if pivot is a tough word for you to digest, at least eases off the gas, right? We know that they're not going to continue 50 basis point hikes indeterminately into the future. Yep. So what do you think we need to see? What do you think we are going to see in terms of the other foot falling from this, cascade from the monetary accommodation or tightening that they started a year ago?
I think that is the right question. And, as I say all the time, right, questions are way more important than answers. And that's why, we make a good pair, because I believe I have answers. I just talk and you have all the good questions. But that's the question we have to answer, right? Which is, okay, it's fine to say liquidity reigns, that I believe inflation is fading, right? That I believe that. That's my first 5, syllables. Economies are slowing. Right? It is incontrovertible that economic growth is slowing around the world. Now, I will argue it's not collapsing like depression, but it's slowing. And I think that's the point of the lag effect, as you say, as rates rise, there's a bite. And how have people survived at this point? How did everybody travel this Christmas and jack up prices of hotels in Park City, Utah? Well, they borrowed on credit cards, right? Savings has collapsed from that massive spike, quote unquote. It wasn't really savings, but we handed people money. They called it savings, but that's all gone. I mean, it's literally all gone. And so credit card debt is skyrocketing, and that, but it is, I believe, like the 2001 recession, which was very shallow, and it had the chance to get really severe post 9/11, but it didn't, because people kind of came back. And I think the same thing's going to happen here. We'll have this shallow recession. Maybe they don't even actually ever call it a recession, although it's hard to argue. If you look at leading economic indicators, you look at prices paid, you look at ISM, PMI, there's nothing other than employment, which I will argue the employment number is just bogus, right? It's the birth-death ratio problem. The fact that they haven't called a recession means they can keep this nonsense of saying that so many companies have been born and die. I just think that's just bogus. And taking people out of the labor market when they turn 65 is just wrong. It's just not true. But facts aside, the Fed isn't going to pivot to cutting anytime soon. Yeah. Which then, how does money supply grow? Well, that actually is the one fly in my ointment, in the sense of, in a world where money supply actually shrunk, global M2 actually shrunk for the first time in decades. It makes perfect sense that equity markets struggled, that private market struggled, that real estate market struggled. But I look out at government debt, right? I mean, Japan last night had to intervene again after they said they weren't going to. They had to go buy bonds because their bond market was seizing. 3 months ago, it was the Bank of England. And the Fed is the only buyer for U.S. government bonds. There's no one else around the world. And this alliance of the aggrieved is going to exacerbate that problem, right? If they are going to price oil from Saudi to China, from Saudi to Russia to China, if they're going to price that in renminbi instead of dollars, demand for treasuries as collateral goes down, just does. And that's my other one about the dollar, right? King dollar dethroned. And look, we've had Brent and the dollar milkshake, and look, we had the dollar squeeze that he predicted, and right on. Brent was exactly right, but it peaked, and since October 24th, dollar's down like 12-13%, and I think it's going down a lot. So.
I actually, usually you and I are pretty copacetic here, but I think we're thinking about this a little bit differently. What's going on, guys? Want to give a quick shout out to this episode's sponsor, Curve. They are the one-stop shop credit cards that helps you take control of your personal finances. Here's the reason that I personally love this company. These guys are all about helping you manage and maximize your personal cash flow. We have been talking for the last couple months about everything that the Fed is doing with raising interest rates. Obviously, no one's got a crystal ball. This is not financial advice, but I think it makes sense more than ever now for companies to be managing their cash flow and for you as an individual to be managing your personal cash flow as well. Curve makes it super, super easy to do that. Even I can do it as the technological Philistine. They aggregate all of your spending information in one place. They make it super easy to plan. But they actually go one step further than that. They have a very cool feature called Go Back in Time, which allows you to switch payments from one card to another. So if you have an unexpected expense crop up, boom, you can move that over to your credit card, free up some cash. Or maybe you learned too late that you could have earned more rewards by spending on a different card. Boom, Curve has you covered there too. And the last thing that I'll say is, if you click the link at the bottom of this episode, you'll get $20 in Curve cash, but you'll only get that if you click the vanity link at the bottom of this episode. Plus, that gives me the credit as well. So thank you, Curve. I appreciate you caring about cash flow. Guys, click the link at the bottom of this episode. Tell them I sent you. My pushback to no one's going to buy U.S. government bonds is, one, I people always say that, but then there's a crisis and then everyone does want them. So I, like my just more recent memory, kind of flies in the face of that. But also one thing that actually guys like Brent have helped me look at is I used to look at the United States as just a country, but now I kind of look at it as a modern version of an empire. And one thing that empires have done consistently is found some way to extract tribute from their sort of vassal states. Mm-hmm. And there's a pretty shocking statistic that's just out there. The US, the Congressional Budget Office, the CBO, is projecting a $1.6 trillion deficit every year for the next 10 years.
Yep.
That's 16 trillion added to the national debt, which is pretty nuts. And one way that you could do that is say, oh, we're going to keep buying up our own bonds, right? Or we're going to rely on demand. Or the US could kind of flex its influence and say, hey, I know that you other countries, China and our allies in Europe, we know you don't really want to buy government bonds, but we'd really prefer if you buy the government bonds. And we're not going to tell you that outright. What we're going to do is say, for your own safety, we think X percentage in your banks, in order to be safe, US, debt is the safest debt that exists. So, to be reserved properly, you should really hold X percentage of government bonds. And if you look at like Basel 2 and 3, like one way you could look at that is like, that it looks, I mean, a definite consequence of that is that banks own more bonds, government bonds, than they used to. So that's the one thing I've always pushed back on a little bit.
No, look, I think it's a really compelling alternative view, and something to that effect has indeed happened, right?
Yeah.
I mean, we ran a $4 trillion with a T deficit in 2020, and I think it got significantly smaller this year because of the accounting, the magic. I love this. You release oil from the SPR, and somehow that's a net export. Are you freaking kidding me? No, it's not. And it's made the deficit go away. Okay, fine, whatever. It's just silly. It's just it's as much accounting gibberish. I hate to pick on him when he's down, but poor Benioff, right? And CRM. Finally, people realized, you mean stock-based compensation actually isn't revenue? What? What? And he's gonna make big layoffs. Stock is collapsing. I mean, look, that company doesn't make any money. I don't know why the stock should be worth anything. So it's a giant sales Ponzi, right? They hired 30,000 salespeople to buy people steak dinners and buy software that they don't really use. I mean, I think about all the CRM software that people have, and they don't actually put stuff in it. I mean, we have it, and I've never used it, not once, not ever, never logged into Salesforce, not ever. And we should just cancel it. Maybe we will. So I look at this from the standpoint of just reality, right? Just normal, harsh reality, cold, harsh reality. The US government has never's a long time, right? Never paid more than 3.2% of GDP in interest.
Yeah.
Okay? And that was at the peak, World War II peak. It got down as low when we were at zero interest rates of 1.6% of GDP. Based on the forecast that you appropriately identified from the CBO, we're going to 7.2. That ain't happening. It's just not, right?
I agree.
It's just not. And the idea that it somehow, it has to. It can't. I mean, it literally can't. There's not enough wealth to tax. There's not enough income to tax. It can't happen.
Yeah.
The things that can't happen don't happen. And so what must happen is a rollover in interest rates. This is not the 70s, right? They've tried to convince us of stagflation and this is the 70s. It's not. We're in a deflationary spiral. We're in an aging population. Old people, right? We don't buy stuff. Okay.
Yeah, I know.
85-year-olds in particular. By the
buy
way,
bonds though.
Pardon?
Buy bonds though.
They do buy bonds. They do buy bonds, and they're going to have to buy bonds because someone's going to have to buy them.
Yeah.
But But the reality is they'll also sell them, right? Because they have to live. So they will definitely buy them, but then they will sell them to pay their bills, right? They live on a fixed income.
Yeah.
And so I look at it and say, on the Fed, how high can they turn the crank before everything breaks, right? I mean, the government can, in theory, again, according to the cult of Kelton, spend as much as they want with no consequences. I think we've seen in the last couple of years that maybe that didn't actually work.
I have a slightly alternative theory.
No.
I listened to a great interview that my colleague Jack Farley gave. I'm going to forget her name, but she's a scholar on the Second National Bank of the United States.
Yes.
So,
Yep.
So this is going all the way back to, Hamilton times, right? But he proposed a national bank, which isn't exactly like a central bank like the Fed, but there was a national bank. The reason that he did that was there was an enormous amount of debt post-Revolutionary War. Also, the debt was like issued from various different states. This was we had the Articles of Confederate. This is pre what the modern empire of the United States looks like today. But the reason for that was that we needed a way to kind of centralize and monetize that debt more effectively. And he transformed the debt, right? Kind of pushed out interest payments. And then an interesting thing that at least happened in the Second National Bank is there was a transformation of debt to equity. Right. So there's actually some of that debt actually gets transferred to equity in the bank. There's restructure. These are classic restructuring moves. And that's kind of how you do these things. So to your point about this debt and interest payments that we can't, I also am of the belief that this isn't going to just continue, right? Eventually, there's an enormous amount of hubris, which we're the issuer of the reserve currency. These things don't matter to us. They matter to us. They don't matter for a longer time than you would normally think because we are an empire and we have tremendous privilege. But eventually, for other empires in the past, they mattered as well. There's a limited number of options that you have to restructure. That's why I do think I'm with you on inflation for this year, but I think structurally inflation is here to stay. If for no other reason, forget everything else. Forget everything else. Forget the demographics. Forget the geopolitical strife and different labor pools. It has to happen because eventually the U.S. has two moves: either to inflate some of that debt away or default. Because we're not going to grow our way out of this at this point. It's obviously not going to.
We're definitely not going to grow. We're definitely not going to pay it back. We can't really restructure it because no one will take the other side. We're not going to give away equity in the United States to other people. Now, could we monetize assets? Everybody always looked at one side of the balance sheet when they talk about the United States. I mean, the United States owns incredible assets, right? National parks, land, mineral rights, resources. Incredible assets. But are you going to sell Yosemite to the Chinese? Probably not. And, are you going to sell it to a bunch of billionaires? Probably not. They don't have enough money because you're taxing it, right? You want to steal all their money. So now, if you made them a trade, like I've been watching Yellowstone, right? You could sell them Montana, where you're from. And okay. But the people in Montana wouldn't like that very much. And Beth would come get you, but
I've got. I actually want to return as well to what you were saying with Salesforce and unemployment. So, something that's a little funny and interesting, right? Is I saw this this statistic on Twitter. I don't have it exactly right off the top of my head, but it was something like if you basically just eliminated all the jobs in tech, all these CRM, Salesforce, Google, Amazon type jobs, that would impact unemployment rate in the US by like 25 basis points, 0.25 or something like that. It's a very, very small but highly visible portion of the population. And one reason maybe that that unemployment hasn't moved even as interest rates have hiked up. If you think about the environment that it's been for the last couple of years, the Fed has been lowering interest rates. That's allowed tech stocks to soar. That's like them printing currency. They've given that to employees. But it impacts such a small portion of the population. Now what you're seeing is a rotation because interest rates have gone back up. Those tech stocks have gotten absolutely smacked, but the companies that have underperformed like energy have risen and they actually employ far more people. You know what I mean? So there's almost an interesting effect here where this isn't a demand-driven inflation. This is supply-driven inflation for the time on top of the money printing, but there's a huge supply problem. So I wonder if the Fed is going to get what it wants. It's taking much longer for the Fed to get what it wants, I think, because of these.
Well,
not every inflation is the exact same.
I know. I think that is a compelling argument. Straw man. I just always look at it that look, the Fed, it's a building full of PhDs, right? Like some of the smartest people on the planet, in theory, according to their credentials, work there, and yet they're over. Like I keep this stat. I mean, they're over 238 or 39, whatever, predictions of GDP for the next quarter. Not like for 10 years out, but just for the next quarter. They're over. They've never got it right. So I always wonder, are they too cute by half or too smart by half? And they're too smart for their own good. And therefore they think they're so smart and the markets aren't smart. And therefore they just don't react to the right stimulus. I don't know. It's weird because they clearly didn't acknowledge what happened. You lock down the world and everything goes to zero. And then you unleash everybody and it all goes up a lot. And you measure that and you say, oh, that's inflation. I'm like, well, I don't know. I don't think oil prices are going to triple again. I think they're going to go higher, but I don't think they're going to go from 40 to 120 again. And the fact that they are now down over the last 12 months means that component of CPI is negative, not positive. So hard to overcome that. And so this idea that they're waiting to react for something, whatever that thing is, whether it's this, mythical employment dip, I don't know. And my thing's still about focus on the wrong thing about the number of jobs. An executive at a tech company is different than a waiter or waitress. Not good or bad people, but the amount of income generated by an executive at a tech fund that has to get a job as a barista, and maybe that's too extreme, but those jobs are not equivalent. I use the same example of Twitter likes.
No, I hear you.
Right? Yeah. My like of a nutrition tweet is not useful because I'm not a nutritionist. My like or of an investment, I hope has some value, but maybe in some areas not. But things are not the same. Right? A job is not a job. A minimum wage job is not the same as a $150K job. It's not the same as $1 million job. It's just not. But we count them the same. And that's weird.
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the two co-founders of Robinhood, Vlad Tenev and Baiju Bot. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you'll get 10% off on a ticket. Again, that's Margin 10 because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. I have a question for you as well about one thing that you always hear about inflation is it's this extremely regressive tax that impacts the lowest income earners.
Yep.
But I've increasingly been seeing, like if you look at real wage changes, right, adjusted for inflation, the income demographic that got the biggest raises this last year was the lowest one. They did better than every other one. And the one that got crushed was the middle part. So the people at the very top income earners, they protected their wealth, right? They have a lot of leverage. The lowest ones, they actually did even better from a proportion standpoint. And the ones who were not able to maintain pricing power was kind of the middle, what you basically call, the middle class or whatever in America.
Yeah, probably the lower middle class, but yeah.
Yeah.
I mean, I get you.
Yeah. I just thought that was interesting. You hear all the time, like it's this very regressive, but apparently, I mean, that's not what the data has actually shown this last year. I'm curious how you think about that. Price
fixing, right? A bunch of people passed a bunch of stupid laws to raise minimum wage. I think is the biggest. Look, I don't agree with price fixing of any kind. And I know other people disagree with me, but I think it's always bad, whether it's minimum wage whether it's interest rates, whether it's rent control. All price fixing is bad. Markets should control prices. If someone wants to work for a lower wage, why wouldn't you let them? It just makes no sense to me. Well, I know what's best for you. No, it's a virtue signaling. It's just pure virtue signaling. It's buying votes. And impoverishing a restaurant owner because he has to pay his dishwashers more, even though there's massive supply of people who will and people, oh, there aren't. Well, that's possibly true because of problems with immigration right now. And the net new, and again, I don't mean this is from a very privileged seat, but there are jobs that the average person just doesn't want to do. I think I've told the story on here the time I went to China with my partners and we went and got this foot massage thing. And it's an hour. You sit in a chair and they give you a bowl of noodles and a beer and an hour foot massage for $10.
Mark, this made a big impression on you. I've
No,
heard this story a couple times. I wish I could have been there for this foot massage.
And I sat there thinking, what American teenager would do this job? What American teenager would do that job? And those girls not only did the job, they were like saving the money so they could open their own store. And my mind was just blown. Like, that is entrepreneurial spirit. That is, and there are a whole bunch of things that people say, I'm just not doing that. But in a tough environment, people are door dashing, right? People are Uber driving. People are Lyft driving. And I told the story of the woman I met driving Lyft, that's her second job. And she is pulling herself out of the streets of South Philly. I mean, she's got grit, but I don't know. I think when you price fix, you create unintended consequences.
Always. Yeah.
And look at the decimation in the restaurant space. How many restaurants do you know personally that have shut down?
A lot.
Like a lot.
I don't know what. Yeah, I have been scratching my head about that. I used to be a waiter, and if you're a waiter, actually, I mean, depends on every location, right? But you actually make pretty decent money as a waiter. Like it doesn't pay with like a classic minimum wage job. Like if you work, if you
do your work,
do your double shifts and everything. No, you can make really good money, and tipping has gone up quite a bit. I've always kind of wondered about that. Like you can't find people in restaurants, but somehow people are stocking retail. Like, why are people taking retail jobs as opposed to being a waiter? It's a million times. Just personally, retail's if you've worked in the service industry before, it's the like retail's the absolute worst. You don't want to work. Like, it's waiting is actually, I always found that pretty engaging. You at least talk to people but
you have a personality and you're affable and it's hard to get a job, right? I mean, good looking guy walks in, affable, you're hired. The average person curmudgeonly mad at the world, I hate to throw him under the bus, my little brother, and get a job as a waiter because he's just grumpy. Like, dude, be happy, right? And then you get a job.
This restaurant made me open, as part of my test, a bottle of wine. This was like a semi-upscale restaurant. I had to open a bottle of wine in front of them. Have you ever tried to open a bottle of wine like this with your hand and you show them the bottle of wine? It's actually, I'm actually glad I can do it now. It's kind of a cool party trick. Yeah.
Well, and using a real, corkscrew as opposed to, the no mess, no fuss ones.
Yeah.
It's, that's, you put it on, oh, you miss, you break the cork. Yeah,
you're in trouble.
Test.
Okay, let's talk about your other sort of non-consensus bet, which is Europe, right? So you just seeded a long only European. So I've been listening. We have a podcast on our network, the Macro Trading Floor. We've got two Europeans actually. So Andreas Stena-Larsen and Alfonso Bacatiello.
Love Andreas.
They're great. They're phenomenal analysts and managers, and they were doing some predictions. They've been covering, just being based out of the EU. They've been covering some of the ECB meetings from Madame Lagarde, who's gone extremely hawkish. It kind of seems like the European hiking cycle is just 6 months delayed basically to the United States. And there's obviously a limit,
right?
Right. It's hard. Yeah. There's a limit to what they can, I don't think they can hike as aggressively, right? They've got, for a number of different reasons, they can't do what we're doing. But I don't know. I mean, what do you think about what makes you bullish on Europe?
Price, right? I mean, prices of stuff just got crazy cheap. People were afraid of, nuclear winter and in the EU, and that Russia was going to turn off the gas and everybody was going to freeze. And look, there are a lot of people that suffered really terrible hardships. I don't want to diminish that at all. I mean, but thankfully, right, they didn't have a super cold winter, and thankfully Russia didn't turn off the gas. And, we don't see the tweets of the $1,000 gas bills anymore. So I just think there's a little bit of normalization. But there's also, look, ultimately, I think it all goes back to China, right? Which is, we made China the enemy, right? Cold War 2.0. But is that enemy or opportunity? I'm thinking it's actually opportunity. If you're in Germany and China's locked down, you can't sell them BMWs or Volkswagens, right? Best-selling car in China is a Volkswagen, actually. Can't sell them cars. Can't sell machine tools. But if suddenly COVID-0 vanishes and it reopens, the biggest beneficiary is Europe. And if you look at the Belt and Road Initiative, it was this long recreation of the Silk Road, which was from Europe to the Far East. And yes, along the way, they take over Africa and, Asia, India, and Greece, right? Which they bought up all the strategic ports, which Greece is another interesting place. It's been terrible for a long time. And I was early, euphemism for wrong, but I think Greece is actually interesting again as an investment haven. But I really think this, again, the axis of the aggrieved favors Europe as opposed to the US. We made China the enemy. We missed the opportunity that it used to be about made in China and importing. Now it's about made for China and exporting. It's the greatest consumptive force in the history of mankind. 750 million people out of abject poverty into middle class want to be upper class. That demographic, and look, it's like 1974, whatever, in China, in terms of consumption and transitioning from a manufacturing economy to a consumer economy. Think about the United States in 1974. We were still on the heels of being the manufacturing engine of the world post-World War II. But then we went suddenly with the deal, right? And 74 is the important year. One, WEF got created. Two, Nixon, shut the gold window. Actually, that was 71, but 74 was the crystallization of gold being legal again. And basically from that point, everything's been about consumption. Right? Now we're 72% of our economy. We just entertain each other, right? We've talked about this, right? We're providing entertainment. People listen to it. We're not producing.
Mark, I've got a great little anecdote for you on this. So I read, do you know Arthur Clarke, the sci-fi author? So I read, it's actually his first novel. A lot of people think it's his best. It's called Childhood's End. And I'm not gonna spoil it because it's a great book. But the premise, which you figure out in the first 20 minutes or whatever, is that aliens come down to Earth and they basically solve all of our problems. There's a lot that goes on after that, but it's an interesting hypothetical that he sort of explores. Aliens come down, they have technology, 1,000 years, thousands of years advanced to our arsenals. No point in fighting them or doing anything. And they actually take over and they solve a lot of our problems. They create a global constitution. Whenever there's an act of, a horrible thing that people do, like genocide or big racial stuff, like they stop it. They don't allow that. Yeah. But they basically let us do. So we're kind of, how would society look after that? Well, two big things. Scientific development and advancement basically stops. What's the point of laboring for something that's been discovered thousands of years hence, and these aliens are just going to give you the technology? Yep. You know what becomes the biggest industry in that paradigm?
Entertainment.
Yeah. Entertainment. And this in 1953, he said, there is such a level of entertainment that some people are said to consume as much as 3 hours per day of media and television and radio. Isn't that a hilarious statistic?
Oh, no, what's crazy about that, right, is because at the time that was unthinkable.
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 Unthinkable. And now
Unthinkable.
I made one of my New Year's resolutions to reduce the screen time on my phone to 3 hours a day. I would be stoked if I could do only 3 hours a day on my phone.
Holy moly! I don't even want. I'm probably. It's only 8 o'clock. I mean, it's only 9 o'clock, and I'm probably halfway there.
Yeah, I know. Same. So,
and I haven't even looked at it since we've been on. But
yeah,
I think that's amazing. And to that point, I tweeted out the picture of the guy who showed himself from the screen time playing Fortnite for 14 hours and 54 minutes in one day, right? Not cumulatively over the week, in one day. So he's living in the metaverse. He is entertaining himself. Now the question is, does that provide anything productive, right? I mean, playing Fortnite, you could argue, okay, he's entertaining himself and he's helping entertain some others because there's collaboration and stuff, but not collaboration, you're trying to kill each other, but other people are involved. And it's good for Epic Games because they're making lots of money. But I don't know. It is a weird dynamic that, especially the part you say about innovation stopping. That's the thing. If you're scrolling Instagram, you're actually not thinking about investments to make. If you are, mindlessly scrolling Twitter, you're not manufacturing a new computer, right? It's interesting. And look, I lived my whole career. I haven't made anything, right? I make money for clients. Maybe that's something, but I don't make it. I mean, I move assets around and I get compensated for taking risks, but I don't physically make stuff. Now, the companies maybe that we invest in do make stuff, especially in venture capital. And that's the one place where I will argue we are adding net positive value because we're backing founders to build businesses that create real stuff. On that, I'm going to throw this out. I'm going to shock you here. So I was at lunch yesterday with, our largest client, and he happens to be friendly with Ben Hunt, who I know you've had on your show. And look, I don't know if I actually ever met him in person. I know I've talked to him over Zoom and stuff, not Zoom, but in the old days. And he worked for a firm that I had a problem with falling out. But here's the offer. I want to bury the hatchet because I don't have any hatchet. I actually have no hatchet. I don't dislike him. For some reason, I hear he dislikes me. But whether we do it on the show, whether we do it somewhere else, we need to just, because we're actually more alike than we are different. And he's got a thing now for BlockFi, and I'd love to talk to him about it because he's got some bad data that I would like to give him the right data. He can have the same conclusion if he wants, but at least do it with the right data. But anyway, that's the offer to
100%. Ben, if you're listening, I think that'd be excellent, either on the margin or just a lunch or whatever. I think that'd be awesome. I want to get back to your point that you're making about people making stuff. And so I'm really torn about this personally. I've waffled. My personal opinion has changed because you hear a lot of negative sentiment in America is attributed laid at the feet of social media. And part of me, there's been so many kind of moral panics, right? Remember, like in the late 90s, early 2000s, video games. Video game violence is causing, and that has largely been disproven, and that's not true. There was a moral panic about Satanism, this cult of Satanism and deviation from religion. And we look back at those things as being just signs of the times, and there was not very much merit to that. So it's really easy to see social media through that lens. But I don't know. I've really been questioning lately how I don't think it has a super positive impact from a happiness standpoint on my life. Another paradigm that you could look at it through is we still have smoking today, right? We've decided, okay, smoking's not good for you, but we're going to allow it. But if you're producing tobacco, first of all, you got to pay a lot of tax. Second of all, you got to put filters in and stuff like that. I wonder if we're just living in an age of social media before we discover the need for the proverbial filter, right? Because
that's a great analogy.
Getting exposed to this stuff, with no limitation, and they're this is what they do. They engineer dopamine hits. That's what they're cooking up in Silicon Valley. That's what they want. They want to elicit that. So you are like a rat in a maze getting cocaine from the little feeder, so that you come back.
And it's not just you saying it, right? Pomp
Something about that just seems wrong. Yeah.
Said on the top of the whiteboard in every conference room, it said addiction.
Mm-hmm.
I'm like, come on.
Really?
Yes.
That's nuts.
No. Again, he's not making it up for effect. We're just having a conversation. He's like, Mark, at the top of the bullet or the whiteboard in the conference room, it said addiction. He said, that's what we're going for. Addiction. Yeah. And so, but look, we see the pictures in the 1800s, everybody's ignoring each other, reading a book. And then we see the picture in the 1900s, everybody's ignoring each other on the train, reading the newspaper. So it's all good. Reading a book, way different than scrolling Instagram.
Yeah, I agree with that.
I mean, I orders of magnitude. I mean, reading a good book, even if it's a bad book, reading a book, you have to use your mind. You're engaging in a story. There's thought. And it's not the constant dopamine and again, the attention, right? Focused reading is hard, right? People don't read for hours and hours. They can't even look at a picture for more than a couple seconds or milliseconds. It's just scroll. The second thing, newspaper. Back then, the newspaper had long form journalism, like both sides of a story, not headlines that were sensational to get the clicks, right? There was actual journalism. There was actually stories. There was public interest. It wasn't, fires and avalanches and that's what, TV news was for. Well, they just talk about fires and shootings. But anyway.
Here's the thing. I mean, that's what people want. So, I have a friend who works for, is backed by A16Z and Gary, it's called Overtime Media. Mm-hmm. And they have a sports league, like a junior sports league that they invested in. You know what their biggest problem is for this sports league? Gen Z doesn't want to sit through a whole sports game.
Right.
So they're changing the rules of the league to make it everything shorter. And again, there's just two ways that you could look at this. Like, there's the old generation; they're always shaking their heads. You can go back. I used to. There's a passage I had to translate in school that I remember. Aristophanes was a Greek comedic playwright, and this was some 2,000 years ago, and they're describing a scene where this father is lamenting the pursuits of his son, the youth, because all he wants to do is play dice. When we were young, it's the 2,000-year-old version of when I was a kid. I walked to school both uphill both ways into the wind
in the snow.
And it's just unbelievable passage you can look at. It's like all they want to do is play dice. So, it's so hard for me to break it apart, but I don't know. It is interesting. I think the thing to watch for those tech companies is, and the other reason I sort of give them investors haven't demanded profitability. They have been indexing for and optimizing towards what investors say they wanted and are willing to pay for, which is growth at all costs. That I think that's changing. It seems like we're at the beginning of that changing. And now I think a lot of these tech companies have actually built really strong businesses, and we'll see. There's going to be a change internally from a culture standpoint. These layoffs are probably going to continue to happen. But I think you're going to see them, the ones that can turn on the profitability spigot, they will do it. And they'll be all the more, and the investors will keep rewarding that. But that's also, that's the business cycle, right? The industry life cycle. And they're probably transitioning from growth to more value.
All right. I'm going to close with one last haiku. Made up on the spot. 2023. Investing will be more fun. Watch on the margin.
All right, we got to close on that. That was phenomenal. It will be more fun. Mark, favorite hour of my week, my friend. This is a great one. I will. Awesome. I'll see you here next week. Thanks, all right. Mike. Cheers.